Good morning from New York. It is 11:15 a.m. on Tuesday, March 24th, 2026. Welcome to the LinksDI Market Briefing. This analysis is AI generated by LinksDI and is for informational purposes only. It does not constitute financial advice. Markets are open and moving, and we have a lot to unpack. What are you seeing right now?
The tape is telling a messy story today. The S&P 500 at 6,576, the Nasdaq at 21,844, and the Dow at 46,267. The VIX is elevated at 26.44, which tells you the market is pricing meaningful uncertainty even on a day where breadth looks decent at 403 advancers versus 111 decliners. The 10-year Treasury yield sits at 4.38%, the 2-year at 3.62%, giving us a positive 76 basis point spread on the curve. This is a market caught between two regimes, yesterday's euphoria over a potential Iran ceasefire and this morning's cold reality that oil is climbing right back above $100 a barrel. I would characterize today as a credibility gap tape. The market rallied hard yesterday on Trump's claim of productive talks with Iran. Today, Brent crude is back up 3.1% to $103.07, WTI up 4.3% to $91.89 because Tehran flatly denied any negotiations took place. That is the single most important data point driving everything else today.
Let us start right there. Yesterday, we saw Brent crater almost 11%, touching $99. Today, it's back above $103. That's a $13 round trip in under 24 hours. What does that kind of whiplash tell you?
It tells you the oil market has zero conviction in a diplomatic resolution. Let me walk through the mechanics. The Strait of Hormuz was handling roughly 20% of global seaborne oil and liquefied natural gas before the war began on February 28th. That flow has effectively stopped. The ADNO CEO, Sultan Al-Jaber, called it economic terrorism against every nation at CERAWeek in Houston yesterday, and he's right. This is not a supply issue in the traditional sense, it's a security issue. Iran says it will permit safe transit for ships not associated with its enemies, but that's a distinction without operational meaning for global tanker fleets. Insurers will not touch it. So you have Brent that touched $112 on Friday, crashed to $99 on Monday on the diplomacy headline, and is now climbing back because the underlying supply constraint has not changed one barrel. Jose Torres at Interactive Brokers put it well this morning. Even if there's a deal, there's nervousness that capacity and transportation disruptions will keep costs higher than where they were before the war. Oil is up over 30% since hostilities began.
And that oil whiplash is flowing through to every other asset class. Walk me through the cross-asset picture.
Here's the chain. Oil bouncing back above $103 this morning is repricing inflation expectations higher again. That's pushing the 10-year yield up to 4.38%, which pressures rate-sensitive equities, which is why you see software names getting crushed today. The top 10 losers board reads like a software index. Salesforce, ticker CRM, down 3.92%. Palantir, down 3.77%. Workday, down 3.57%. Paycom, down 3.65%. Meanwhile, semis are surging, with 9 of the top 10 gainers in technology, specifically semiconductor equipment. Corning, ticker GLW, up 7.63%. Teradyne up 6.69%, KLA Corporation up 5.46%. That divergence is the market saying hardware and physical infrastructure hold pricing power in an inflationary, supply-constrained environment, while software multiples are compressing because their customers face margin pressure from rising energy costs. The energy sector scorecard is extraordinary. 100% of energy stocks are above their 50-day and 200-day moving averages. Nearly 91% are near their highs. Compare that to technology, where only 28% are above their 50-day and 21% sit near their lows. That's a textbook sector rotation driven by a single macro catalyst.
And there's a real-world infrastructure story buried in here too. Amazon Web Services is reporting another disruption in Bahrain from drone activity. Two AWS facilities in the UAE were directly struck by drones earlier this month.
That's the second-order effect people are underestimating. The Iran conflict is not just an oil story, it's a cloud infrastructure story. Amazon, ticker AMZN, is advising customers to migrate applications to alternate AWS regions. That's a structurally significant development. When you have physical damage to data centers in the Middle East, it forces enterprise customers to rethink geographic concentration of their cloud architecture. That benefits U.S. and European data center capacity providers, but it also raises costs for any company that was using those Gulf regions for lower latency service. Amazon is flat today, essentially unchanged, but the AWS disruption compounds what was already a challenging quarter for the stock, down over 8% year to date.
So let me ask the question every investor is asking. What does all of this mean for the Fed?
Here's where it gets uncomfortable. 2 months ago, the market was pricing a gentle easing cycle. The Fed had room to cut because inflation appeared contained. That narrative is functionally dead. With Brent back above $100 and the national average gas price at $3.96 per gallon, up from $2.94 just a month ago, according to AAA, you're looking at a direct 35% surge in consumer energy costs. That feeds through to headline CPI within 4 to 6 weeks. The Fed cannot cut into rising energy-driven inflation, full stop. With Fed funds effectively at 3.62% based on the 2-year yield, the market is pricing a prolonged hold at minimum. But here's the risk. If oil sustains above $110 for another month, we could see break-even inflation expectations spike enough that the Fed has to signal tightening is back on the table. What was a rate cut narrative 2 months ago has shifted to an extended hold, and if the Strait of Hormuz remains closed through Q2, it shifts toward potential tightening. That's a regime change for every duration-sensitive asset in the market.
That's a striking shift, and it explains why the yield curve has steepened to 76 basis points positive. The long end is pricing in persistent inflation, while the front end reflects the Fed staying put.
Exactly. The curve shape is doing the Fed's communication for it. The long end at 4.38% is saying this energy shock is not transitory. The front end at 3.62% is saying the Fed is not going to panic cut into a supply shock. That steepening is rational, but it creates real pain for anyone positioned for the flattening trade that would accompany a cutting cycle.
So who are the clear winners and losers from today?
Let me break this into layers. Cyclical winners. Energy producers are the most obvious, and the sector scorecard confirms it. Every single energy stock in the S&P 500 is above its 50- and 200-day moving averages. Defense contractors benefit from the Iran war directly, and you are seeing companies like Scion Power pivot entirely from EV batteries to drone batteries because the demand signal is that strong. Semiconductor equipment names are also cyclical winners today because they hold pricing power and benefit from reshoring trends. Structural winners, renewable energy and clean power infrastructure. The UK just mandated solar panels and heat pumps in all new homes, explicitly citing the Iran war as justification. Utility stocks with 74% above their 50-day moving average are the second strongest sector. And data center operators with US-based capacity benefit structurally from the forced migration away from Middle East cloud regions. Cyclical losers. Enterprise software is getting hit hardest today. Salesforce down nearly 4%. Palantir, Workday, Paycom, all bleeding. Their customers face rising input costs from energy, which pressures IT budgets. Private credit is also a cyclical loser. Moody's downgraded FSKKR Capital, ticker FSK, to junk yesterday. Non-accrual loans at 5.5%. The fund posted a $114 million net loss in Q4. Shadow banks are blocking withdrawals. That is acute stress. Structural losers. Rate-sensitive consumer discretionary faces multi-quarter headwinds if the 10-year stays above 4.3%. Airlines are a nuanced case. United is reporting strong premium demand and rolling out new premium cabins, but jet fuel is spiking. Airlines are short-term beneficiaries of strong demand, but medium-term losers if oil sustains above $100, because fuel is their largest cost input. That bifurcation matters for how you position. And Microsoft, ticker MSFT, is a structural concern, down over 20% year-to-date, the worst performer in the Mag 7. Melius Research flagged the Copilot reorganization as a red flag. Only 15 million Copilot seats sold out of 450 million users, a 3% penetration rate. CapEx hit $29.88 billion in Q2 fiscal 2026, up 89% year-over-year. That spending is not yet generating commensurate returns.
The private credit story feels like it deserves a closer look. Moody's downgraded a KKR-affiliated fund to junk, shadow banks blocking withdrawals. That sounds like the early innings of something bigger.
It connects directly to the macro story. Private credit boomed during the low-rate era. These funds lent to middle-market companies, many of them software firms, at floating rates. Now those borrowers face two headwinds simultaneously: rising input costs from the energy shock squeezing margins, and clients delaying software purchases because IT budgets are under pressure. FSK's largest loan category is software and related services at 16.4% of exposure. That is exactly the sector getting hammered in public markets today. When Blackstone and Blue Owl are both dealing with elevated redemption requests, and Moody's is downgrading the second-largest publicly traded BDC to junk, you have a credit stress signal that reinforces the risk-off posture in rate-sensitive assets. The causal chain runs Iran war pushes oil above $100, which spikes inflation expectations, which keeps the 10-year yield pinned at 4.38%, which pressures software company margins, which causes their private credit loans to go non-accrual, which triggers fund downgrades and redemption gates. That is a 5-step causal chain from geopolitics to credit stress, and it is playing out in real time.
What is the risk case investors should be stress testing right now?
The base case is that the 5-day strike pause leads to some form of back-channel negotiation. The Strait of Hormuz partially reopens within 6 to 8 weeks. Brent settles in the $85 to $95 range by late Q2. The 10-year yield drifts to 4.1 to 4.25%, and the S&P grinds towards 6,800 by mid-year on relief. The Fed holds through September. The risk case is that Tehran continues to deny negotiations. Trump's 5-day strike pause expires with no progress, and strikes resume against Iranian energy infrastructure. In that scenario, Brent spikes back above $112 and potentially to $125 if Iran retaliates against Saudi or Iraqi production. That pushes the 10-year yield above 4.6%, forces the S&P down to the 6,000 to 6,200 range, which is an 8 to 10% correction from here. Private credit redemption gates spread to more funds. The VIX breaches 35, and the Fed is forced into explicit hawkish guidance by the June meeting, potentially signaling a 25 basis point hike for September. Consumer discretionary and growth software would face a 15 to 20% drawdown from current levels in that scenario. For positioning, here's how I would structure it. Highest conviction: energy producers immediately increase over the next 4 weeks. The supply constraint is real regardless of diplomacy. Secondary conviction: U.S. renewable energy and utility infrastructure maintain and gradually increase structurally. The policy tailwind is now global, with the UK mandating clean energy in new construction explicitly because of this war. Tactical hedge: short-duration treasuries and gold. If the VIX stays above 25, gold provides genuine diversification. Avoid enterprise SaaS names with high revenue multiples and no pricing power. The IT budget compression driven by energy plus AI disruption, which Databricks is targeting with LakeWatch at $134 billion valuation, creates a two-front war for traditional software. Also, reduce exposure to private credit vehicles until redemption pressure stabilizes.
How does it all fit together?
When you step back, this is really about the market repricing the cost of geopolitical risk into every asset class simultaneously. The Iran conflict is not just moving oil, it is reshaping inflation expectations, which reprices the entire rate curve, which forces sector rotation from growth into real assets, which triggers credit stress in the leveraged lending complex that financed the prior cycle's winners. The energy sector at 100% above its moving averages, while software sits at 21% near its lows, is not noise. It's the market telling you that the regime has shifted from financial asset inflation to physical asset scarcity. Every portfolio decision today needs to be filtered through one question. Does this holding benefit from or get hurt by a supply-constrained, energy-driven inflationary environment? If you can't answer that clearly, you're carrying risk you haven't priced.
Give us 3 takeaways to close it out.
First, the risk. The 5-day strike pause is a ticking clock, not a resolution. Iran is denying talks happened. If hostilities resume Friday, the Monday sell-off reverses violently and oil retests 112 or higher. Plan for that. Second, the market insight. The divergence between energy at 100% above moving averages and software at 21% near its lows is the widest sector dispersion in years. That is a regime signal, not a rotation trade. Respect it. Third, the positioning idea. The highest conviction trade in the market right now is long energy producers with short duration hedges. If Hormuz stays closed, energy prints higher earnings every quarter. If it reopens, you collect carry while rotating profits into beaten-down quality growth on the other side. Either way, you're on the right side of the macro.
Thank you for listening. This is Links DI, and we'll be back tomorrow with your next market briefing.